Might as well record it, right? All right, so specifically, I'm going to kind of walk through what my review process is like. I'll cover most of the things that I did while studying to kind of improve my attention to detail and kind of train myself as to how to look at price action. So I'm using NAS because NAS is Bay. I didn't use TradingView, but I find that TradingView is a little bit easier for everyone. So I start on a 30-minute chart. Let me get this indicator off. And I find the first day of the week. Now, clearly, I don't know these things off the top of my head because who does that? What do you use other than TradingView? MT4. I literally live on trading on MT4. But I'm a kind soul. The week started on the 5th. So I'll slap a vertical line on the 5th at midnight, New York time. Here. So while there are some parts of this process that have been refined, just want you to understand that this is how I started and this is how I started doing that. Then we have last day of the week, or you could push it to wherever midnight New York is going to be on Monday. Now that I have that, we need weekly opening price right there. Could put the magnet on, but where's the fun in that? Then you want to get an idea of where was the high of the week formed. That's right here. Well, the low and the high was formed right here. So once we have those, I want to go inside price action and dissect to find what was present that showed price was possible or likely to trade down here, and was there a setup that formed inside this fractal that offered a rules-based approach that I can repeat going forward. And I'll do maybe 2 weeks and then leave you guys to backtest the idea. Yeah, magnet is when you, yeah, can't be bothered really. So for simplicity, let's get the other daily dividers on, so I don't have to be guessing. So that would have been Monday. This is Tuesday open. Tuesday goes to here. And Wednesday, there's probably an indicator for this, right? Somewhere. And if you do know the name of the indicator, feel free to share. Save me drawing time. Alt V. Oh, no, this I have to try. Because I don't know what to do. Didn't work. That's the 8th. The 9th, midnight is there. ICT kill zone, 8:30 and midnight. All right, we'll do that for the next one. All right, let's do it now. NY open divider. So I need to exit full screen. So you guys are teaching me today. ICT, I forgot the name. What's it called again?
Just type New York open divider.
New York open divider, okay. NY.
NY. Open, yeah. Second one.
This one? All right, thank you.
Yep. No worries.
So remove the drawings. We'll go back to full screen. All right, perfect. So now, only thing I really need then is going to be one horizontal line. You can push shift to make it straight. That spans the entire week. So I get an idea of the weekly range. So this is how I studied. So that's there. So the law of the week was formed here. We want to study what happened when this law was formed. Right off the bat, just looking at this data, what I have is that low right there, which would have been Monday's low. We have Monday's low being taken on Tuesday. Our order block would be, yes, I'm ICT charter, kind of. So here's a Monday's low, right? So rough analysis, we can see that the law of the week was formed by Tuesday taking Monday's low, and then we ran and took out Friday's high. And I'm not going to check if there's another liquidity pool somewhere over here. We don't need to do too much. Relatively equal highs sitting inside here. Looks like the draw. We don't want to form fit the idea too much, right? You want to have an approach that you can repeat. If you try to pick the exact high that it went to, you get a little bit into the wishful thinking department. So what we have, let's stick to what we have. We have Monday's low being rated on Tuesday. There's a market structure shift on Wednesday. Price traded higher, took Tuesday's high right there. So at that point in time, we have, just to get that eye emoji. Wait, one sec. Somehow somebody escaped mute. So here we have liquidity, Monday's low being rated. Then we have Tuesday's high being rated. So off the bat, there was something happening inside here that created a range, and that range, both sides were swept. When both sides of the range was swept, or whenever both sides of a range is swept, we know we have a dealing range. All right. So this is just rough analysis. We have a range. Tuesday's took Monday's low. Tuesday's high was taken. Wednesday creates a dealing range. Thursday offered a setup and it went into Friday. So at this point, you start asking yourself, which one of these moves looks most appealing for you? If the run on Tuesday down to Monday's low is what you're after, then just gonna push this over. Let's leave it. Kind of drop inside here. Where's that text icon? There we go. Tuesday. So we put that there and we drop inside Tuesday on a lower time frame and study the delivery that we have here. So let's do that. I like M5. So drop the M5. And the day was here. So now we start dissecting the price action. Tuesday's high was formed at 3:25 a.m. You could mark that out if you want on a notepad in your notebook or something. Tuesday's low was formed at 10 a.m. Again, that you can mark out as well. But we're more interested in the run, what part of this idea was tradable? Picking the highs, picking the lows, not a tradable option for me. Let's go deeper. Someone's in the chat. How would you approach trading on Mondays, or do you just avoid Mondays and wait for higher low to form? Yeah, letting everyone in. So a trading process is many things. You want to have a structured approach. If this, then that. Based on your preference, you can say that if Monday does something, I'll trade Tuesday. Or if Tuesday does something, I'll trade Wednesday. My belief, right, and I strongly believe this, that the algo that works in the market needs a look back range. If it starts working at this time right here, it needs to look back to find old highs, old lows, order blocks, imbalances, stuff like that, so that the new delivery that takes place after has targets to run to. If you adopt that idea, then you can pick whatever time you want to start. Midnight Monday, New York open on Monday, so you get Monday's range to look back. Whatever it is, just find something and stick with it. Or you can find something and test it initially. But let's dive into this. So looking at this price action, this run here is not the highest high. So I like this trade idea. So we drop into this and we go back and we look at what was in price action right here that suggested this run was possible. First thing I'm seeing is that we took, okay, this thing is, let's play, okay. He wants to play. Monday's high. That's the first thing I'm seeing. I'm seeing Monday's high being rated right there. Sessions, this would have been, wait, I think I have an indicator for that. Bam. There we go. All right, so nice. So now I can remove this box. So we can see that the high of the day was formed in London when London traded through Monday's high, which was also Monday's Asian session, right? So Monday's Asian session created the high of the day. Then London took the high. Well, this would have been Tuesday's Asian session, my bad. Then we took the high and then we ran lower. The run lower started here inside 8 a.m. to 11 a.m. We have a run on Monday's high. Where's the candle that closed above here? Trading Views and app that is easier to use. Do it. No promises, all right? Can't promise you that I'm gonna go through all that trouble, but nice suggestion. This is a candle that trades through this high. So if you watched the video from yesterday on YouTube, you know why I'm selecting this. If you haven't, please don't ask in the chat. So that's our order block. If this is our order block, there are a couple of rules that I have for order blocks. If order blocks represent institutional buying or selling, there must be some amount of displacement from the order block to validate it. It's created here, we trade below it. Decent enough for me. Nice movement away, runs a low, market structure shifted. If this end of London took out a high, we have buy side liquidity being taken right there. And this end of that swing trades below. It's in so many lines now. This low right here, it means we have sell side liquidity being taken right there. So if we have a price swing that takes buy side and sell side liquidity, That's our dealing range. Let's pull it over so we can extend it into New York for reference. So if that's our dealing range, right? We know that once a dealing range is created, there is a high probability that price will retrace inside the dealing range. So if you want to check, did price retrace inside the dealing range? Yes, it did. Where did it retrace to inside the dealing range? It retraced to the order block, and then we pushed lower again. So from a process, every market structure shift, no, there are different market structure shifts that you've probably never heard about, but I think you in particular should know it. So we have dealing range created here. We expect a retracement inside the dealing range after they take the sell side liquidity. This candle here, if it was a larger range, I would be willing to buy this as an order block to trade back inside here. But when would I buy that? When price trades above that high. So let me hide the indicator. Let's zoom into that portion right there. This candle right here, I'd be willing to buy that when price comes back down as an order block to trade higher into this. Buy to sell. Why? This is an order block and I'm expecting a retracement back inside the dealing range. Yeah. Shift and drag. I guess I just can't be bothered, like I said. So now take a look at this fractal. Inside our dealing range, we now have a short-term high. Guys, can you mute? I think I'm muting everyone, but somehow some persons escape it. There's buy-side liquidity now resting inside your dealing range right here. If that's your buy-side liquidity, this is where most persons get a little bit tripped up. Your trade, your entire trade idea is framed around this order block sending price lower. This is hindsight, but kind of explaining the process so that you can see it live and anticipate it. This is the order block your trade is framed around. If there's liquidity here below the order block, we don't sell into this and put our stop here, because then you're pooling liquidity for the market makers to grab. If you're FOMO or you're victim of FOMO, what in the name of Allah did I just do? Okay, here we go. If you're going to FOMO here, FOMO responsibly and put your stop loss above the order block. Putting it inside here just because you don't want to lose too much should be the first indication that, hey, you know, I'm probably FOMO in this trade and I probably should wait. Internal buy side gets taken. This high does not trade through that high. This is a model right here. Yes, you can FOMO responsibly. This right here is a model. When you have an order block at a high, price creates a dealing range. There's a short-term high inside the dealing range that price raids without breaking that high. You can reclaim this, or you could trade this as a reclaimed order block, which means selling at that order block, factor in spreads and use the low. Stops above right there. There. And once you enter, you look back. Where's the lows? Or where are the lows or the liquidity before I got in? It would have been all of these lows, all of that low. That's your trade. I've explained this model in a video before on YouTube, but hey, for the guys who didn't fully catch R3, would I have entered before? Yes, I'd enter in this order block. I'd enter in this candle when price is trading here for many reasons. We already saw the order block being created. We already saw the dealing range being created. When price retraces to the premium end of the dealing range inside the order block, that's multiple confluences, short. Where's your target? Where's the liquidity? Where's the liquidity before you got in? So if I got in at 620, all of these lows before I got in becomes liquidity. Best case scenario, I get all of them. Worst case scenario, I get a couple of them, partials break even, and I walk away. Sounds like a win to me. So that would have been the trade. Monday's low, I believe, where's that thing? Here. Would have been taken right here. So now we get an idea that Monday's low, we found a trade in hindsight that gave us a run on Monday's low. Do you still use 8 a.m.? Yes. This depends on what session you're trading. So let's say you're trading a different session besides New York. Then that would have been your entry. But this entry formed at 8:05. So the best opportunity would have been there, but this assumes I was up before 8. Now let's say I was not up before 8. How would I have gotten a trade inside here? I would have seen this displacement here running below this low. And my first thought process would be, if this market is bearish, we should come back here, fill in any imbalances, and then push. Immediately after the imbalance was created, it was rebalanced on this big wick, then price pushed lower. We ran Monday's low, then it retraced. I have no interest in going short here anymore because the liquidity pool has been taken, or it has been purged. So at this point in time, I'm thinking, based on the time of day, there's no trade. Tomorrow, I'll find a setup. Tomorrow, we zoom out, would have been Wednesday. I'm looking for a retracement or a run higher to buy side, since we already had daily running on sell side liquidity. And I'm looking for where was the optimal trade setup formed, which would have been here. The guys who went short here, probably at break even, I want their stops. I'll be scared to say that. No problem, no problem, no problem, no problem. It's fine if you. How do you know when to trust them? Back test how many times they form. You never know how to trust a model that you learn. But what you can do is backtest how many times it forms across maybe 6 weeks, 3 different pairs every single day. Do I have a setup every day based on the same rules? If 4 weeks out of 6 gives me that setup, that's a high probability model. Adjust your RR or your risk based on what those numbers are, and then life becomes a little bit easier. But let's jump into Wednesday. Here's our Tuesday low, I think. No. Well, no. Tuesday low would have been here. Here's our Tuesday low. Wednesday pulled off Tuesday's low. We're looking for highs to be broken from Tuesday. That could potentially initiate a market structure shift. Justice, confidence comes with data. Good one. The last high before Tuesday's low was formed comes in here. Form 15, that's the actual high. No, but we traded above that one. Why not use that one? Because this is the first one I see. Once you trade above this, that initiates a market structure shift. If this low took sell side and we run above that high and it's taken buy side, we now have a new dealing range. This low, in fact, did run below that. So we have dealing range. Take this off, clean up the charts. If that's our dealing range here, I want my entry to form at or around an array that's formed at 50% of this range. Watching hindsight trades us pop out. Always, but if you journal, you could learn from the hindsight. So at 50% of this dealing range, we had old high being broken, Candle trades through. This is the candle that comes back to the old high. Order block candidate because it trades through an old low right there. So I'd be projecting that out in time, like so. And I'll be waiting for price to go above, comes back. That's my long. If I'm going long here, where's my target? We're looking back for the highs that were created before we got in. So that's the order block. Bam, assuming wrong one. Assuming we're using the open, no precision filters yet. Wow. Put that here. Order block low. Now for the highs. This is the first high. This is probably where you go break even or take partials, depending on how far away it is. Looking back, we have these highs here. We have these highs here, and we have that high. So best case scenario, we're thinking that's a trade I want. That's best case scenario. Outside of best case scenario, we have short-term targets that we can take along the way. There, and I guess cloning don't work when I use it here. Okay, that's fine. And here, these highs. You could use bodies or wicks depending on your personal preference. I prefer bodies, less stress. Imagine a trade coming right here and the wicks is here and it starts retracing and you're like, oh my God, do I take or do I not take? I remove that question altogether. The question of where do I get out comes out by me saying at the highs, I walk away. So that would have been the trade idea right there. Take profit hit right there and we walk away. I don't care about it going higher. I don't care about squeezing another 5-10 pips out. My plan was to get in here, target that. I got it. We're done. So Wednesday would have given you this idea. We haven't factored in much higher time frame in this analysis because once you understand what we talk about here, you could take this on any time frame. You could play the H1 chart with this analysis. You could play whatever time frame you're comfortable with. Yeah, that's what I was doing. Or maybe I was pressing shift, I'm not sure. I always use liquidity pool because I don't believe that quote unquote bias is a real thing. I think the market is just running for liquidity or rebalancing an imbalance. So if you're wondering, do I go bullish or bearish tomorrow? Where's the liquidity? And what time do you start trading? If this is a range right here, if I start trading on Wednesday and I'm thinking, is the market going to be bullish or bearish? I'm thinking, where's the liquidity? I just saw us run below a low on Tuesday. These highs were not hunted. So anybody who went short and moving their stops to break even, their stops are at these highs. If your model is 5 minutes, how dependent am I on daily bias? Again, daily bias simply means what side of the market liquidity are we drawn to today? That's it. So on Wednesday, sell side was just taken in this range of Tuesday's high to Tuesday's low. There are so many highs that were created that the market did not run on. That's liquidity building up. So once I get the sell side run and the market structure shift, I start framing where I want my trade to form. We talked about that here. We talked about why this would have been the trade, and we talked about where's the target. I don't look for daily or weekly templates. I don't. There's two things ICT related that I'm not actively putting in my trade at any point in time. SMT, daily profiles. Simple. The daily profiles I look at are what I see from my own back testing. Running on previous day's highs, market structure shift, running on the highs or the lows, whatever. right? So yeah, I trust what I see. So that would have been the trade. Best case scenario, if you aim for higher or all of that, you can see it play out. But this is enough for me to do whatever you're doing. In or done. If you're doing a challenge, 11 hour, 0.5%, 5% for the day, done. Walk away. Thursday, we have a day or a price swing. Which open is better? Asia or New York? I would submit that neither of them is useful, but that's for a different conversation. So we have sell side liquidity being run here, then price trades up through Tuesday's high. That makes that, well, I don't have to do a click a new one. My bad. I could just put from here to here. New dealing range, right? So some of these guys can come off. Get out of here. You get out of here. And we're looking at a raise at or around 50%. At 50% of this price swing, we have old high. Let's take that off as well. Being run right there. Right here. There's a candle that closed above this guy right here. Which means if an order block is going to be formed, it is very likely going to be formed inside that. So at this point in time, I'm expecting an order block to be formed down here. Price pushed higher. This has not been retested, or we haven't traded back here. So I'm not interested in randomly buying that. Market comes down. Let's put this SLB on to get London. Let's see what the market was doing there. Lots of questions in the chat. Why don't you drop below 50%? And what about PD area matrix? What about PD area matrix? It's just another tool, one that I don't use. No grand explanation. Yeah, I'll probably upload it to YouTube. But not everything that you see online as a way to trade is something you should implement in your own trading. You just need one or two things that you can use repeatedly with live data and get the same result. Backtesting an idea is one thing, right? Somebody saying buy that order block is one thing, but why do I buy that order block? I mean, what's the point in that? What I've given you in the last two calls is a clear process. Sell side liquidity run, well, liquidity run, dealing range, retracement, entry. Clear. The more you practice, or if you write that down or create like a checklist, did we have a liquidity run? Did we create a dealing range? Did we retrace inside the dealing range? Yes. Look for entry. Anyone of them know? Wait, don't do nothing. That approach to backtesting is better than, oh, a trade from here and I could have gotten in here and I could have put my stop here. Do that with live data. See a candle forming now and say, oh, this is a candle, let me put my stop here and enter here. That will crush you. But creating a checklist, did we have liquidity run? Yes. Buy side and sell side. Did we have a dealing range created? Yes. Did we retrace inside the dealing range? That depends on where are you in the market. When liquidity grab and dealing range is created when we have buy side and sell side taken. Somebody said something about TV. What is the name? Like it's right here. ICT New York Open. I've never used it or seen it before today. Somebody just recommended it at the start of the call. Market structure shift and market structure break. Cool question. A market structure shift happens inside a range. A market structure break happens when we're leaving an established range. Here's our range. Well, this would have been our range from Tuesday's high to Tuesday's low. Trading above an old high inside the high to the low of Tuesday is a market structure shift. Taking Tuesday's high on buy side delivery here, that's a break in market structure. All of this bearish day is now bullish delivery. Or if you want to put it a little bit better, sell side delivery, buy side delivery. Change in the state of delivery, look back for your raise, enter, boom. So let's just wrap up what we have here. So we expected an order block to be formed here in fair value or fair value for buying. This is where most persons get crushed and switch models. If an order block is going to be formed here, what are some of the things that must happen? It must be a down close candle. Must. Here's a down close candle. Most persons see this down close candle and like, oh my God, my POI is invalidated. Oh no, what am I gonna do? No, we don't do that. If an order block is created here and it's going to be a down candle, allow it to close. It doesn't matter if it trades all the way down here. If price opened and that was a down candle like this, it's still valid for an order block. But we now need price to trade back above the open before I can consider taking a trade. If you see this big down candle forming and you say, okay, this is going to be an order block, let me buy the opening right here, you're crazy. Because if this screams low, what are you going to say? Order blocks don't work? Nah, your approach to order blocks don't work. FBFB/S, no idea what that means. Fair value for buying or fair value for selling? Fair value for, think of it this way. Large liquidity must come in at opposing liquidity. Large selling takes place at large buy-side liquidity pool and vice versa, which is why that's where I expect my order blocks to form. Once the order block is formed and validated, that gives me order flow or context for the next state of delivery. We run this high, we create an order block, we retest it, bearish delivery. Where are the lows? Down here. We're in a dealing range just created, bearish order block created. I'm thinking market condition is now retracement. Retracement seeking balance, month one. Where are the imbalances? Down here. That's another key that you can use as confluence. If a dealing range is created and we're now expecting an imbalance or retracement to an imbalance, this is fair value for buying. Do we have an imbalance? Imbalance. Allow market to trade. Market comes down. There's my down candle. Boom. That opening price right there, fair value for buying. When the market comes back, I'm willing to go long. There it is. Long here, targeting that high. Game over. Game over. Zoom over. Quick study session. Hopefully that was insightful. Thank you guys for coming out. Yeah, I tried to keep it simple. Less moving parts, the better. Continue.